Hi, I'm Brian Cordes, head of the Portfolio Specialist Group at Cohen & Steers. We believe preferred securities present a compelling total return opportunity in today's market. High-quality preferreds, primarily issued by investment-grade rated companies, offer yields in the 7 to 9% range as of middle of November 2023, which is considerably greater than what's available from investment-grade corporate bonds. Many preferreds are also selling at 10 to 20% discounts to par value, and historically these securities trade near par, so the deep discounts represent significant capital appreciation potential for patient investors. And there's a sometimes overlooked aspect to preferreds unavailable for most other fixed income categories that makes them particularly compelling in today's potentially higher for longer rate environment, that being their resetting dividends. Over-the-counter preferreds, which represent roughly 80% of the preferred universe, feature dividend reset structures, in contrast to the exchange-traded preferred issues, which are primarily fixed rate in perpetuity. More than 10% of the preferred market will either reset or be called in the next 12 months. These securities typically were issued when short-term rates were significantly lower than where they are today. Given recent strength in the U.S. economy, Federal Reserve cuts are generally not anticipated before the second half of 2024. And with preferreds periodic payment resets, just the passage of time should lead to significant increases in income for investors if the securities are not called. Here are a few real-life examples we can look at. Most preferreds reset spreads are in the 250 to 400 basis point range above a given benchmark. Many reset over short rates, such as the Secured Overnight Financing Rate, or SOFR, while others reset over longer benchmarks, such as the 5-year U.S. Treasury. Typically, the near-dated fixed-to-reset securities are trading at more shallow discounts. In our view, this makes them particularly attractive as paid-to-wait inflation beaters in the near term. Of course, issuers also have the right to redeem securities at par value at that reset date rather than increase the dividend. But with many shorter reset securities currently trading at discounts to par, a redemption would only increase these securities' total returns. And if a security is called, investors can then use those proceeds to invest in issues that are most likely yielding more. Income investors may be tempted to consider other alternatives such as high-yield bonds or leveraged loans, also known as floating rate loans. Both of these have been strong performers as of late, in part because they too can offer lower rate sensitivity. Floating rate instruments have benefited investors in a rising rate environment. But while high-yield bonds and leveraged loans offer greater pre-tax yields than preferreds, they are substantially lower quality investments. For instance, the high-yield market has an average credit rating of a single B+, described as highly speculative by rating agencies. In contrast, preferreds are typically issued by investment-grade rated companies and, on average, possess a rating that's 4 to 5 notches higher than the high-yield market. High-quality issues with resetting dividends are only part of the preferred's total return story, but they can offer comfort in an unsettled investment climate. Thanks for watching.